One conversation we're trying to explore, we talk to investors, we're trying to understand what are their objectives. We're starting with what they're looking for, not necessarily. We have products, right? You have a finite product, so it's more or less looks a certain way. But the basic question, are you looking for income? Are you looking for growth? Because if you're going to put a growth deal, your syndication, heavy value add syndication, in front of an income investor, they're going to ask you what's going to be my quarterly distributions, and you're going to tell them, well, they're not quarterly distributions. Mm-hmm. Why? Because it's a value add deal, and it's a mismatch immediately. So at least start with understanding what your investors are looking for.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, is John Cohen. How's it going, bud?
We're hanging in there. We are we're rocking and rolling.
Yeah, good things going on.
Yeah, why not? Let's be optimistic. Right now, we got a couple of interesting things. We have a couple of BPOs coming back, BOVs. So hopefully, we get some good values here. I'm excited. I think some good things are going to start happening.
Gotcha. Thinking about selling, thinking about refinancing, just seeing what the market's like. I just want to gauge some values. I think we're more in the refinance bucket. I mean, a couple of our properties will definitely be for sale this year, but a large bulk are probably just refinance because I think there's a ton of value on them that we could take advantage of as opposed to just what we normally do would be a straight sale. Mm-hmm. Yeah, I hear you. I don't know about you, but I was talking with somebody else. It just feels like it's been a very sleepy January so far. I felt like there would be a good deal of pickup back with like business and deals and conversations and stuff. And it just still feels like, I don't know, this like holiday hangover, or people are still super, unsure with, COVID lingering out there. But I thought there'd be a little bit of a pickup already, but I guess not.
Yeah, our newsletter actually was sent out today. And I actually said, there's like a 2020 hangover. I don't know if I thought more would happen. More people would be optimistic about some good news, but it's taken a little bit longer to get shit going. But at the same time, it still is early, right? People are trying to get their footing underneath them. I think just, it's like a spillover, but, we're rolling, we're sending out mail, we're cold calling. So I'm excited. I think, our pipeline's filling up with some, longer term closings, but some deals I think coming down the future.
Nice. Awesome. Great to hear. But let's jump into today's episode. We got a really great guest on today. Excited to get his take, hear his story, and learn from him as well. So that being said, Mike, thank you so much for joining us.
You're welcome, Chris.
So
thank you, John, for having me too.
Absolutely. Kick us off a little bit. Tell everybody a little bit about you, your background, your journey, and what you do.
Sure. So I live in Brooklyn, New York. I've been here since mid-90s. Originally, I'm from the former Soviet Union. You guys are kind of young. I don't know if you remember when it was Soviet Union. It broke up in 91. I left in actually 89. I came to the States just under 18. I've lived here ever since. I'm a U.S. citizen, U.S. patriot. So that's. But I live in New York. Married over 21 years, 4 kids and a cat, 5th child. If you have a pet, you know what I'm talking about. And I've been doing real estate part-time. So I had a career in software development and then executive all the way through mid-90s till 2009. In parallel, started investing in real estate 2000, mostly in New York here, kind of buy and hold, very passive. And then I went real estate full-time 2009, becoming a fund manager. It kind of went from there, launching our family of funds, Tempo family of funds. And we've been investing in broad range of real estate opportunities, anywhere from your classic turnkey property to financing a lot of the fix and flips, to investing in commercial, pretty much broad range of projects. So it's what we do today: multifamily, self-storage, industrial. Latest trend, COVID created conversion of hotels to multifamily. kind of affordable housing. Do good, get rid of the old dysfunctional hotel, make it into affordable multifamily. That's it. That's what I do. Other than that, busy with kids. So
I can imagine. I do want to get into all the stuff you're doing today a little bit later, but I want to start back in, kind of your journey, because I think a lot of people listening are probably still working in one facet or another, and you were obviously able to make the shift over from working full-time to being a real estate investor full-time. What was the reason you first got into real estate back in, I think you said 2000 or 2000?
Yeah, 2000. Yeah, originally the first purchase was primary residence.
Mm-hmm.
Most people should do this. This is as basic as it goes. Some people try to buy investment property first. You could do that too. There's nothing wrong with that. But I bought my first apartment where we lived for a number of years, and then I bought a bunch of other apartments and some other real estate here in New York. The primary challenge doing this in New York is everything is very expensive, and it gets even more expensive. And I flipped some, I kept most, and kind of regret selling everything I sold because seems like the appreciation has been pretty good here, at least until COVID hit. Things have sort of stalled now. But why I bought it? It's just you need to live. You need a place to live. Once you own primary, you realize the benefits of real estate. Essentially, I bought it for cash, then I refinanced, used the cash from refi, bought investment property, so it went on and on and on. If you can do that, if you can buy right, buy at a good price, then refi, and then continue buying. That's pretty basic. It doesn't have the scalability factor, but it has enough to keep going. You could do it as much as you can muster your own capital. So kind of.
It's interesting that you say, we talk about selling deals you wish you wouldn't have sold, because it's something I've heard from a lot of more experienced guys that have been in and out of deals in the past. And I hear this, this saying that you hear a lot of times in the stock market, it's time in the market, not timing the market. And I feel like that saying I've never heard translate over to the real estate side, where it's always like people are so eager to be in and out of deals, and you very rarely hear that same mantra carried over to real estate investing. And yet when I talk to people who have been in it for a longer time, so often they say something very similar to you. Oh, I wish I wouldn't have sold that deal. Oh, I wish I wouldn't have sold that deal. Do you think it's just a consequence of real estate takes more capital to do than putting $500 into the stock market? Do you think it's just, people want to be in and out of deals and repurpose capital? Do you have an opinion on it, or I'm just curious what your thoughts are?
Chris, that's a great fundamental question, right? It's as fundamental as it gets.
Right.
So real estate historically it'll appreciate a certain rate of return. And because of a leverage, the compounded rate of return generally beats the stock market, right? Mm-hmm. So it has worked better in real estate than it has worked in stock market because of the positive leverage. Now, it is a function of the market. I'm in New York. The market has been, ever since I came to the States in '89, it's been almost linear appreciation. Velocity of appreciation has gone up and down, but it's been upward trend. So in markets like New York, that's a pretty straightforward story. Now, it's stalled now. Manhattan has sort of stalled. I'm not in Manhattan, mostly in Brooklyn, but it's still, I believe it'll hold. Once COVID is over, it'll continue. Now, if you go into more cyclical market, Midwest, Southeast, and so on, the cyclical market are the Phoenixes, Las Vegases, and other ones, kind of Southern California, Southern Florida. Yeah, you have to watch out in those markets. You may need to time the market a little bit if you can. But if you're on a steady Eddie markets appreciating kind of steady pace, you're just better off keeping it, investing the money for long term and not touching it for a couple of reasons. One, transactional cost, right? The moment you flip, there's cost, acquisition, disposition, taxes, insurance, all that jazz that happens. So there is no right or wrong philosophy. If you can afford to acquire and then keep for a long time, it works. I can tell you there's only really one driver to change your investments. It's a return on time, not necessarily the return on investment. So as you mature through your investment life cycle, you basically build higher wealth and more investments. You want to have less headache with what you got. So if you have some turnkey houses that you bought 20 years ago, 10 years ago, even 5 years ago, but you have outgrown them and you don't want to be dealing with them, you may want to sell and invest into a commercial property or something a little bit more easier to manage. You'd be basically dealing with the institutional level sponsor or a fund manager. The returns may or may not be the same, but if your return on time improves, that's a worth a consideration. So I'm selling some turnkeys now because I'm not happy spending a lot of time interacting with the manager when a tenant leaves, the turnover, everything else is consuming time. So your return on investment may still be good, but return on time is no longer. So the other way people look at this is when they have trapped equity. So if you are a non-cash flowing market like New York, the question becomes, do you refi, take the cash out, do you invest, or you sell? And that's a question if you can refi, right? If you can refi, generally refi till you die. But if you can't refi anymore, or you're not getting good enough LTV, then you can consider selling and rolling the money into something else. So it's a function of opportunity cost, right? What better opportunity do you have, both on time and return on investment? So if you have some properties you've owned for a while and you have a better opportunity, then you got to get the capital somewhere. So you either go and you start raising third-party capital, or you sell what you got and you get into the new deal. So that's kind of a trade-off. Does it make sense?
Yeah. Oh, so I don't think enough. I mean, I know enough people talk about it, but that component, there's something to be said about, trimming the fat, right? A deal that you take that takes a lot of your time, those are more primed to sell if you can repurpose that capital, and the opportunity that you give up and you gain, yes, it might not be a 20% return or a 12% return. It might be a 5 or an 8 or whatever it is. But if you can shift your time and get a little bit less, and now you can use your time in a better direction, people don't even evaluate that, because out of the box, everybody wants to make so much money. But with that comes a lot of headaches more often than not. So the way you broke it down is one of the best ways I've seen it and heard it, from a lot of the guests we've had on the show. And even, I've been saying it for a while. There's something to be said about that, a little bit less, maybe it's a little bit nicer, maybe it's a little bit newer, where you're not going to have that maintenance, the constant management calls, the constant turnover, whatever that looks like. So I think that way that was broken down, it should really resonate with people starting. Because if you're just getting started, yeah, it's nice to make a big return really fast. But at the same time, slow and steady wins the race. And, over time, you can really build a really well-oiled machine. And then you can pick and choose, okay, I want to get rid of this property and maybe a triple net lease or whatever it is to, alleviate some of the headaches. So I really liked it.
Thanks, John. Yeah, the only other comment is, because I don't know if you guys know the Collective Genius Mastermind, and known as the CG, some of the heavy hitters in the country in that mastermind. And I'm in that group. I've been since 2012. And there was a really interesting theory circulating, flip 5, keep 1, flip 3, keep 1, for those guys who were flipping properties. The only reason the flips were required is because you need to pay the bills, right? Pay marketing, pay other ones. So the flips were the way to pay, but it's not a wealth building. It's just keeping the lights on and that then building up a little bit the capital. But in general, yeah, you're right. Like all of us are right. If we find the right assets worth keeping, that is easy to keep for long term, that's the right asset.
Mm-hmm. Yeah, I think it comes back to, to hold deals long term, you got to have capital put into them. And I think it's solving that X part of the equation to get to the Y part of the equation. You've got to generate revenue somehow, whether it's, having a W-2 job, or whether it's being a real estate agent, whether it's flipping, whether it's wholesaling. A lot of people do one thing in order to buy another. I mean, we've had several people on that wholesale, flip, are real estate agents, and they say, I do this to buy X. And usually it's like rentals or mobile home parks or something else that's definitely more longer term focused. And I think that's one of the things, we talk about a little bit. When you get into the syndication game, it's, syndication doesn't always generate enough fees up front or until you sell to support co-investing alongside your investors. And something we used to talk about a lot of how do you solve that variable when you're just in the syndication game? And it's not always an easy answer. And I think that's why we've seen recently so many deals where there's 2, 4, 7 co-GPs that come together because they don't quite have the funds to invest themselves, but they can raise $500,000 at a clip. And not that there's anything wrong with that, but I think things start to get very muddy when you start to bring that many people in for a deal like that. So I think it's interesting how a lot of people solve that problem. And it's interesting to also hear that, a mastermind that you're in separately was basically having the same exact conversation about how to solve that problem to continue to allow to buy things longer term.
Yeah, great comment. So the one I'll comment on your last comment. Having too many partners could be as bad as having no partners at all. Mm-hmm. So you definitely want to partner with people who you kind of know, like, and trust. It's like you invest with anybody. You want to find the right partners. And if in general, we invest in a lot of kind of commercial deals. And what I do see in the more kind of developed space, you have a few principals, primary partners, who have developed the ability to acquire, manage, and obviously take the full life cycle assets. And the reason they do bring co-partners, not necessarily for capital raising, although I've seen some folks bring kind of capital raising partners, but the challenges of bringing a lot of partners, they all, I wouldn't call them necessarily all partners. Technically, they're co-GP to help raise capital, but in reality, they all fall into the bucket of capital raisers. You're better off finding one capital raising partner who can get all the money than having 5, 6 each bring in 500,000 apiece. Mm-hmm. But in general, any partnership you do, you either find credit partners, money partners, experience partners, credit partners. But if it's too many, the pie is watered down too much. So,
mm-hmm. I hear you. So just so I understand exactly what it is you guys are doing, are you raising funds to invest alongside deals? Are you acquiring deals yourself and also investing? Like, what is your business model currently?
Sure. So we have 2 flagship funds: Tempo Growth Fund, Tempo Growth Fund, and Tempo Opportunity Fund, which is our income and growth fund, mostly income. Once we launch Tempo Growth, which is a newer fund. So Tempo Opportunity is an open-ended, Tempo Growth is closed-ended. Without getting into details, we're mostly fund of funds. So we invest into other funds and syndications and individual deals. Sort of picking and choosing. Our model is very different from a traditional. We start with people kind of who we know, like, and trust, develop the relationships, and then continue to invest again and again in the next series of deals. And it's very opportunistic kind of capital allocator. The way to think about it, we're capital allocators, not necessarily stuck on any strategy. It's more of what makes sense today. If things change, we will change.
Mm-hmm. All right, good. No, thank you for clarifying.
We don't own anything directly other than debt. So the only time we really own real estate directly is when we wind up, for closing on a property, or we partner with somebody on a deal, but we want a working partner. We want to be passive. Mm-hmm. Sort of that's the philosophy.
Gotcha. And I wanted to clarify that because you touched on something earlier that I wanted to ask you more about. Was you're talking about converting hotels into affordable housing. Is that something that you just see as like a huge demand in the current market? How did that come about, and why are you guys investing in that type of deal?
Yeah, it's a great question. So I've done a good amount of educational content in the space, and I believe it's a substantial trend. It's something, obviously, COVID is a terrible thing for the world, for all of us. We're struggling with it. It'll take us a long time to overcome it. I don't even know with the new vaccine coming out, we're going to have annual shots or not. Who knows, right? None of this stuff is clear. But what is clear, it has disrupted certain sectors of real estate. Pretty obviously disrupted hospitality substantially. It has disrupted some level of retail, obviously, and other sectors. So when we looked at this a while back, we realized that this is a massive opportunity. These hotels are sitting empty. People are not traveling. Can they come back? Yeah. It's going to be slow recovery path. They're bleeding cash. They're upside down. And they're sitting in great residential neighborhoods. And the cities are struggling with not enough affordable housing. It's a no-brainer. highest and best use for that asset is no longer a hotel, but more of studios. Hotel rooms are small in general. Can you make them into small one bedrooms? Yeah, depending on reconfiguration. So we've done some of the projects we've done, like Residence Inn, but Marriott flag. Some of them are failing. They're good conversion candidates because they look like mini apartments to start with. So that's the basic thesis. I think it has a lot of legs. It has opportunity to keep rolling for a while. It's sort of, they have to be the right hotels. It's not your Motel 8 on a highway, right? It is a embedded hotel or motel style hotel, which you could see like Ramada. They look like motels, but they're called hotels. They embedded into residential neighborhoods, or good location is important, right? Where people want to live. And if location is good, that's a good candidate. Obviously, economics have to be there. So you have to be able to acquire at a good price, and obviously do construction, repositioning, redevelopment, and come up with a product well below the reconstruction cost. That's the basic thesis.
Mm-hmm. Quick question there, because I think it's something we actually have on my list. I would love to do one, right? I've thought about it for so long, and it makes so much sense. And we're looking for them. COVID obviously helped that. The affordable housing component is interesting, right? Now, affordable, not government, just a good, affordable place to live. How do you guys get over the hurdle of like the size of the apartments? Are you combining, like, does it have to have a certain amount of doors? And are you combining units to make 2 bedrooms, or are you guys keeping that studio 1 bedroom layout and it doesn't matter the size per se?
Sure. So I'll give you some examples. So we have some of these projects that went coming on full life cycle. So pre-COVID opportunity. These projects existed in the past. COVID sort of accelerated the trend. And a few new ones. So we in 2020 we did 3 or 4 new. We had 1 pre-COVID, and we're doing probably a dozen this year, 2021, if not more. So the general theory is the Residence Inn, couple of them really straight up. You don't have to do much, just convert them because they look like mini apartments anyway. You don't have to change configuration, walls, none of that stuff. You just have to carpet and paint, clean up, make sure kind of internal, external, it looks like a hotel. The hotel appeal turns into housing appeal. So those are easier. The Ramada Inn, they're small, and depending on the location, it's really, really a function of, you have to do kind of study and see where the demand is. They actually work really well for students. So we did one in Mesa, Arizona, downtown Mesa, right next to light rail. Because there's a train stop right next to it, it's good transportation hub for students. And students probably don't mind living in if you think about it, it is like a dorm room, but with your privacy. And it probably costs less than the dorm room. So it works for students. It'll work for workforce housing, another good word, instead of calling affordable. Let me just kind of state it, because people think affordable, Section 8, not necessarily Section 8. It's just affordable for that area. A studio that you could rent for $650 a month versus 1 bedroom for $850, $900. I mean, you may be okay with less space if you want your privacy. It comes down to that. So I think that's what's important. Can you reconfigure 2 of these studios into a 1 bedroom apartment? You can, but can you get double rent? Yeah, if you take 2 rooms, probably not. So the answer to your question is probably a whole bunch of studios rather than some reconfigured apartments. Under some circumstances, it can make sense, but most likely you'll retain as much configuration as possible. Also, you're complicating construction the moment you start breaking walls and changing the layout.
No, without a doubt. I mean, we're actually looking at a deal now that's got, the guy started building it. The opportunity is to finish the construction. And that's where he's going to give a discount because he doesn't want to deal with that headache, which we don't mind, although it's probably not going to work. And it was a former extended stay. So it actually did have a little bit more than, a traditional hotel room. would offer a tenant. But I think that, the key there is that affordable component. Like you said, would someone take a studio or a 1-bedroom or a studio at, a 30% discount to what the market says? And if you can achieve that, you're probably going to be pretty safe, on lease up risk and stuff like that, because you're going to, good workforce, solid housing, new construction. Typically hotels have some type of amenity package that you can repurpose. So you're going to give them Class A amenities where something they would never get in a like kind building. If the location's great, it's got good transportation, it's got good retail. And that's typically where you see a lot of these potential opportunities in really solid locations. I think you nailed it. You don't really want to start breaking down walls, right? That gets expensive. You want to sort of keep it what it is, upfit it, make it really nice, give it a sick amenity package, and still keep your rents affordable, be well below replacement cost, so you can rival what new construction would cost. And that's typically where you find a really nice, really solid opportunity. So it makes a ton of sense. It's something that we really love. We've been trying to shake down opportunities, and it's just been, they're not there yet, but it's something that we're dying to do this year. So, that was a little mini education for myself and what, to make sure, we're looking at it the right way. So I appreciate that. And for everyone listening, obviously they're awesome deals.
Yeah, you're welcome. The question is, where do you get these opportunities? It's not trivial. Sometimes you can get them through distressed sale where this thing is upside down pretty badly, and the bank is the decision maker. And the couple we got in, actually, they were struggling pre-COVID. COVID knocked them off, and they were already pre-foreclosure, and they finished foreclosure during COVID. The commercial wasn't stopped. Residential stopped. They have a moratorium on residential, but commercial can still continue. So that's an opportunity. The banks have been, what's interesting is the banks have been slow to foreclose if the regulators have given them a break. So if you can get a hold of the owner, obviously, and see if you can make a deal with them, maybe if you can bring fresh blood, fresh capital, fresh ideas, you can work out something out with a bank. The banks are not greatly motivated until this thing is considered to be in default. They cannot keep it in forbearance. The forbearance is kind of lets them let the problem slide down, the road. But we don't know this. We know residential forbearances are going to continue for a long time now. With Joe Biden in the House, in the House and the Senate, they're going to approve even no moratorium on evictions and moratorium on foreclosures. This will continue. I don't know how long. But commercial, I don't think they're very motivated to give big breaks to the real estate investors. They think of a little guy. So my guess is commercial foreclosures will continue to the degree that the regulators don't put pressure on the banks. If they put the pressure on the banks, the foreclosures will continue. If they don't put the pressure on the banks will keep these deals in forbearance for long enough. So it'll kick the can of problems really down the road. Otherwise, you would see more deals today. That's sort of the theory.
I agree with that theory. I think that I don't think the shoe has dropped yet, and I think that everything that's happening, all the regulations and everything, it's just kicking the can down the road, right? Does a bank really want to take back a disaster property? As long as the regulators don't. There's a lot of problems that are going to happen in the future, and we don't know what those are, right? Forget the residential component for a second, right? Because I agree with you. There's no light at the end of the tunnel on the forbearances there, right? They said till April. That's going to get extended for the foreseeable future, in my opinion. And that's going to be a whole nother problem in the future. Where does the commercial component fit into that? Well, I think it depends on the asset, right? Does a bank want to take back a property that's worthless? No, because who's going to buy it not knowing the outcome of where this is going to list? So there's a lot of things that are going to be kicked down the road. So I think it's a great theory. And I think, using that to your advantage, where if you could, get the owner on the phone, have a conversation, see if you can shake that deal free, you're going to have the bank, by the balls, for lack of a better term, because they're going to, they don't want it, right? It doesn't do anything for them. A vacant property with all restrictions all over the place, it's not going to help anybody. So I think those are really key points to shaking free deals free. Try and find those properties that may be, feeling a little pain, and seeing how you can put a deal together.
That's right. So it's you got to get creative. If there's some equity left, you could do seller financing. You can do a wrap. If there's no equity left in a deal, you basically can't pay big enough price. But you have to basically reverse engineer it. You have to start from the back, figure out what it could look like once you take it through the redevelopment, and then what would it cost to do the work, and then what you can pay. It's kind of a tricky, but it's definitely a reverse engineering problem. Not any different than what's the ARV on a house. So what's the max you can pay? You take the ARV of the house times 75% minus cost of construction. That's your max price. Same concept applies to the hotel.
100%.
Yep. I do want to bring up another topic too that I think will help a lot of people, because while hotel conversion is sexy and I think everybody would love to do it, it's probably not for everybody or as impactful for everybody listening. But I think one thing that everybody can or would like to do is raise money from investors to make their money go further, be more diversified, things like that. Having been in real estate since 2000, and I'm sure you've seen a big shift in how real estate and capital raising has changed over the years with the rise of technology, new regulations, things along those lines. How are you looking at capital raising today, and how are you setting yourself up for the future of capital raising?
Yeah, it's the holy grail. You're basically asking fundamental questions. It is always it's a journey. So multiple things. One, you got to become an educator. You got to become an expert. Sort of, if you want to read there's a good book called No BS Marketing to the Affluent by Dan Kennedy. He's one of the most profound, marketing gurus. And he talks about ACE, authority, credibility, and E stands either for expertise or for exclusivity. So whatever you got to sell to affluent or not, you gotta build sort of that authority and credibility. And usually education it helps. He or she who educates sort of dominates. It's a basic concept. So education helps as you spread the message out and you get people to follow you, and then you provide thought leadership. You can attract some dollars, but it comes down to making basically a marketing plan. How are you going to raise capital? And there are different opportunities. So when there's Wall Street, big institutional, and you go kind of Main Street, we are one of the smaller, I'll just call them small investment funds. So are you going to raise from small institutional investors like us, or are you going to raise from family offices, which is about the same kind of category I call them. Then you got high net worth individuals, and you can define what it is. It's obviously a credit investor, but the avatar has to be ideally bigger. The bigger it is, the bigger the check you're going to write. So there's no right or wrong. I define it 2 to 20 million range, maybe more like 3 to 4 to 10 million. So it's that if you can raise from those high net worth individuals, they can write bigger checks. Then you got kind of the capital raising by affiliation, working with the influencers. What's been a typical trend. So I've seen plenty of gurus and experts. They have, let's just use an example, a self-storage education, self-storage academy, self-storage mastermind, and you're a self-storage aspiring investor. You basically approach a guru and say, I got this project. I want to partner with you. You got a whole audience of people. And that's a path to a bigger audience faster, because that specialist, you know the product they bring to the audience. We're trying a number of things on social media, but we're very, we're kind of our first journey there. Most of capital we've raised is relational through mastermind groups and affiliations with the where there are these affluent investors. So if you can associate yourself and you can be one of the experts, you'll get some amount of attention for capital raising. It's not easy. You have to be invited in these groups. You almost can't get in. You can't pay to play. You have to be an expert to get there. The fintech itself is there's a lot of sites out there, and we've tried it with a few of them, and it didn't really go anywhere. It's hard to say what what works, what doesn't. Some sites are pretty good with one-off syndications. Funds are a little different capital raising. So depending what you're raising your money for. You're raising money for a fund, you're selling a story of the manager. You're selling the manager and the strategy. If you're selling one-off syndication, you're selling definitely the manager or the syndicator, but you're also selling individual asset with individual characteristics and specific numbers. So it's all of the above. It's never one. It's for sure continuous education, spreading the word, and you get that. It's affiliation with the right groups. Again, the fintech, it's something that you can explore if you can get on some fintech platform, and you have to see, is it worth it? The fees, the costs. At the end of the day, you're trying to acquire that end customer, the investor. And ideally, you want to acquire the one that has more than a small check to write. So I strongly believe that marketing to the affluent is much better path than going Reg A plus, kind of going to the masses, because you're going to have a lot of small investors, and it's a massive customer service project. Having the few and better investors is the way to go, in my opinion. But you got to get in front of them, and that's basically marketing to the affluent. So I don't know if I gave you enough here, but it's a continuous evolution we're exploring today. All I can tell you is that white papers used to work really well. Today, on-demand webinars work a whole lot better than white papers. And you guys are kind of probably know this better than I do, but we've done some exploratory work, and we're learning. Probably number one technique out there, but you got to have a compelling story. Kind of, I don't know. I'm a mathematician by education. I can tell you that too mathematical, too technical doesn't appeal at all. So we've improved, we're changing, we're learning what would, so for that, the social media and more of let's just call them latest evolution platform, it's still exploratory for us. I don't claim to be a guru, I'm a student there. But marketing to the affluent, for sure, we've gained good amount of that. We'll continue to do. It's affiliation is the best referral by far. I mean, beats the heck out of any cold, probably to a ratio of 20 to 1, maybe even more. Mm-hmm. So whatever investors you got, ask for referrals. Ask for referrals softly. Write a book. Get the book to them and give them 3-4 copies. Pass it to the neighbor. Stuff like that.
Mm-hmm. Yeah, I think you touched on something that's really interesting that I've been learning a lot more about, or at least I kind of knew, but it's interesting here. It breaks down. It's kind of that storytelling versus the informational side. And there's a lot of studies and research done. A couple of books I've been reading lately that touch on this, basically that like when you're arguing with someone or you're trying to discuss something, people don't resonate with, necessarily like statistics or facts or whatever. But if you can somehow tie into the emotional component of that emotion will then, if they can start seeing your side through that emotional side, then it'll tie back into the statistics and the data and stuff like that. And the example that somebody gave that was really interesting was talking about person riding an elephant, right? The driver of that combo is not the person on top of the elephant. If an elephant wants to go do something, it's going to go do it. So if you think about the person as the analytical data side and the elephant as the emotional side, you can kind of imagine how people make decisions or overturn, a belief that they have. And if you want to convince someone to put money into a deal, unless they already have the full backing and belief in the specific type of deal in a specific area that they already want, you don't really have to attack their emotion. But if you want to persuade someone or inform someone or get someone to think about looking at a certain anything, whether it's a deal, a fund, just a belief you have, going after that emotional side with the storytelling has shown to greatly impact the ability to have somebody else see your side of the argument, belief, thesis, whatever it may be. So it's interesting that you brought it up as well, because it's something that has been hitting home a lot lately for me.
Yeah, it's a great point, and I'll add a little bit more to this. Again, still learning this stuff, but um, uh, it's not just your story, but you have to kind of understand the story of the person you're talking to. So you have to establish the connection. So there's no like and trust. You gotta somehow build a bond with them. And really, the building the bond is by far more important than whatever you're selling. I mean, this is now basics of selling, and I'm not a guru and an expert. All I can tell you is just what I'm observing. If you can somehow connect to them, and they feel that you are understand their needs, and whatever you're offering is helping their objectives, that can accelerate the path. And yeah, I mean, it's all of the above. It's serving them, not them serving you. It's appealing to the emotional side. The emotional drives action. Also, you could break this down even further. Dan Kennedy is really good about this. Just depending on who you're talking to. If you are talking to, and again, we have to be careful when this age of what you say, but he does break it down. If you're talking to an affluent woman, it's a different conversation. If you're talking to an affluent man, they're different drivers of the behavior. And understanding that, it's important because you're trying to tune your story to the person you are presenting to. So, but it is a journey. It is learning experience. All I can tell you that people have asked many questions. People have even reached out to me, hey, help me set up a fund or syndication, because I do a lot of the mathematical setup. And your whatever you're raising money for needs to match your capital raising strategy. That's one mistake people make. Just give you sort of the wisdom of someone who's raised a lot of capital. If you set up the wrong structure, your capital raising will get easier or harder depending on what who you're pitching to. So it's just fascinating to me that people will set up a deal and then they go out with a deal without thinking who they're going to pitch the deal to, because these terms are good for them and they like the terms and they set it up. They've decided these are going to be the term. Instead, go to your investors first, ask them the questions, find out what they like, what they see, especially if you have investors, what kind of terms would be good, and then set up the structure. It's almost like reverse engineering. When you know where the demand is, then you can create the supply.
Mm-hmm. Yeah, I think that's important too, because you touched on something that you said you got to be careful what you say, and how you talk to different people is going to change. But I think that's just a fact of life, right? The way you talk to your parents versus how you talk to your children versus how you talk to your best friend for a number of years versus somebody you meet off the street, they're all different versions of you. So why wouldn't you also present a slightly different version of yourself when you're talking to different investors? So I don't think there's anything wrong with that. I think people just fail to realize that they do that every single day. Every person that you meet and every person that you interact with has a different version of you in their head based on your relationship with them. So I don't think there's anything wrong with saying that when you talk to an investor, if they're different, they have a different life story, they have different outcomes, that you're going to approach that situation differently. Not by any means, right? It's the same thing, right? No Fortune 500 company that does marketing runs the same ad for, preteens as they do for middle-aged men, right? That would just be, and you ask 100 people and 100 people tell you that's the dumbest thing they've ever heard. So why wouldn't you do the same thing when you're talking with investors? So I just, for anybody listening that may have been like, I don't want to I don't want to tailor my message and try to trick somebody. You're not tricking anybody. It's literally in every facet of life. So I just wanted to bring that up.
Yeah, exactly. And it goes even further. The one conversation we're trying to explore, we talk to investors, we're trying to understand what are their objectives. We're starting with what they're looking for, not necessarily. We have products, right? You have a finite product, so it's more or less looks a certain way. But the basic question, are you looking for income or are you looking for growth? Because if you're going to put a growth deal, your syndication, heavy value add syndication, in front of an income investor, they're going to ask you what's going to be my quarterly distributions, and you're going to tell them, well, they're not quarterly distributions. Mm-hmm. Why? Because it's a value add deal, and it's a mismatch immediately. So at least start with understanding what your investors are looking for. So
yeah, I mean, every phone call that we have with investors before they invest in nickel is doing exactly what we said, trying to figure it out. And a lot of the deals that we do, very similar to you are either kind of that value add, heavy growth, no distribution, or, longer term cash flowing, some growth, but less growth type of deal. And it's really trying to drill those down and figure out with investors, telling them, hey, some deals are like this, some deals are like this. And, sometimes they're somewhere in the middle too, right? Not every deal is completely to one side or the other, and just trying to figure out, what they're looking for and does it match what we're providing, whether it's, some of the deals, all the deals, and just trying to make sure that everybody's aligned. Because I think one thing that, John talks about a lot is that not all investors are a good fit for the deals you're putting on paper. And it's equally your responsibility to understand what they're looking for as it is the investor's responsibility, so that you don't have a problem, 6 months into it and you haven't given a quarterly distribution. And, the person you took $50, $100, $200,000 from is expecting X amount of dollars and they haven't gotten anything. Is it their fault for not understanding what they're putting their money into? Absolutely. But it's also your fault as well for not understanding what their expectations are before going into the deal. So you did not do a good enough job, just as they didn't. So people have to understand that relationship as well.
Yeah, it's kind of what you said makes a ton of sense. Obviously, we do this day in and day out, and there's many dimensions to this. It's not just income growth. You also have time horizon, you have liquidity, you have risk tolerance, and so on and so forth. But what is really important is to, again, get an idea who is your audience. For sure, you can still market the product that you got, but if you have a mismatch, and if it's a single, if your product is a single, one of the interesting things that happens right now, just a little tangent, but a lot harder to find income deals, a lot easier to find growth deals or value add deals. So it's the market conditions, low yield environment, yield compressed environment. So a lot of people want income and they can't get quality income. It becomes a very interesting, dilemma. What do you do if you are putting together a deal? It's going to be really hard to offer them basically an income product when the deal is growth. You can solve some of this with creative financial engineering. We're still working on some of these ideas now, but the concept is the same. It's got to match kind of investor to the product. But if you have one product, how do you do it? And the key is, don't burn the relationship with investor by putting them in the wrong product, because they're going to get pissed in a couple of months. They're going to find out, hey, they're in the wrong product. So, but it can be structured. I'll give you one of the ideas. It can be done. You can set up common preferred equity. You can create primary debt, mezz debt. If you structure things a little differently, you could put people into the right bucket. The question is, what returns can you pay, risk adjusted to each? But you can do more than just the bank loan and then the equity. So that's all I'm saying. If you need to create income, you can create an income by creating a preferred equity tranche or mezz debt tranche. And that's a way to go. If you bunch of investors want debt product or an income product, and all you got is common equity, and then you just gotta you're increasing the risk for the equity, but you gotta magnify the returns because you're shifting some of the return as payable cash on a monthly basis to the mezz debt, for example. Does that make sense?
Yeah, 100%. So
stuff like that.
Yeah, let me ask you a question. Are you, because I think you brought up an interesting topic that some people may not understand or don't think about, right? If you take up that common equity position when there's a preferred equity position, you're now adding more risk onto your plate as the common equity piece, because there's now more money that's going to get paid out before you than just the debt, right? Now it gets paid out debt, preferred equity, then common equity. Do you have any interest in deals that have a preferred equity piece to come on as the common equity? Or do you find that the risk reward in that common equity piece is often, not enough for you to be interested in?
Yeah, absolutely. The answer is it depends, right? So we've looked at the deals that were structured where we've participated in deals. We have a substantial investment in a very large multifamily we did in the middle of a year that had first lien debt from a large insurance company, kind of like a bank loan. Mm-hmm. And then it had a substantial chunk of preferred equity. And then the common equity is where we took a piece. And the reason we took a piece, it has a number of other benefits. So one, yes, it's outsized leveraged. So the deal with the common equity was leveraged off the top of my head to 87% between the first debt and the preferred equity. So common equity is only 13% of the capital stack. It's higher risk for sure. So it has to be the right mindset. But it has substantial benefits. It has outsized pro forma IRR, and we actually believed it. Very, very competent sponsor who the project is it's like 7 months into the project, he's getting the rents upon renovation completion higher than the pro forma. If you have that upside, you actually want to be in that common equity because you have outsized returns. So you have one, higher projected target IRR, understanding the higher risk. Two, you can get more depreciation because preferred equity, depending on the structure, may not get it. And obviously debt doesn't get it. Your common equity is now picking up a whole lot more depreciation. If you want it, that's great. Those are key, variables to the equation. There are a few other ones, but at least the basic ones: depreciation shift and then the outsized return shift. If the numbers work, why not? It's a risk-adjusted return. It's all about risk-adjusted return, and if depreciation makes your life a lot more attractive. The deal was give you an example. So the deal had depreciation to the degree where it was 2.5 to 3x every dollar put. So you put $100K in, you get $250,000 to $300,000, whatever the range of accelerated depreciation. If you are a real estate professional or you need the depreciation to offset capital gains, right? It's the other use case scenario. By investing in a deal like this, instead of writing a check to the IRS, you're writing a check into the deal. So the depreciation alone sells the deal. And then now you got outsized IRR. Hey, why not?
Gotcha. No, that's good. And I think it's important because I think one of the things that we've been seeing in some other deals as people are doing some syndications is they're starting to add, I'm seeing more deals with the preferred equity component. My feeling is that a lot of people are throwing that in
to magnify the return to the common equity.
Not even magnify, they're getting to the same returns that they were looking for just in general. And I think a lot of investors don't understand that relationship between preferred equity and common equity, especially the one-off guy who's writing anywhere between $50,000 to $25,000 to $200,000 a check. I don't think they fully understand that risk reward. And I was happy to hear you say that you are looking for increased IRR returns because of that additional risk, where I've seen a couple deals where it feels, at least to me, I'm from the outside, so I try not to judge too much, but just from the outside looking in, I've seen a few deals where it feels like they are throwing that preferred equity in, not only to give people, the income side that they're looking for, like you said, but they're also trying to get that IRR on paper that they're normally trying to shoot for, when in reality, it's really not quite the deal that people think they're getting, which...
Yeah, Chris, it's a brilliant point. I've seen exactly that. So the behavior is like this. Just the classic use case. The target IRR, you have an audience that's used to, let's use an example, 20% target IRR, but the deal doesn't have it. What do? It's only 16. So the sponsor is scratching their head and they say, well, now if I get preferred equity that's paid 11, 12, maybe I can get the common equity IRR to 20. So they're increasing the risk. And they make the deal pretty. In reality, it's not a good enough deal. Most people miss, is this a good enough deal? And when you're trying to make an average deal to look good, you're putting lipstick on a pig. And it's exactly what you said. People do this all the time. And I mean, this is the whole idea why people invest with competent sponsors and guys like us, fund managers. It's because we know the stuff. We can tell the difference. They can't. Most investors, anything you put in front of them. I remember Staples had a wonderful button called "That Was Easy." That's a one button. You don't have two buttons. It's one button. Most investors have one choice. You press the button or you don't. Yes or no. And you could put an inferior deal in front of them. If they don't know better, and they know, like, and trust the sponsor, they're done. They're cooked. They just invested in the deal. And if it's a great sponsor, hopefully they'll figure a way out years down the road. But a lot of these deals, life cycle is long, and that's the challenge. So, lessons learned for investors is that the deals from a year or two ago is no longer what they look. They don't look the same way today. Could be the same sponsor, but the deals look different. The other thing that I see progression with sponsors, I call it they get fat. Good sponsors get fat. They start shifting the economics of the deal in their benefit versus what they were doing in the past. Why? Because they were successful and investors made good returns and they're loyal. Now they're saying, well, before, I had 8 pref and 70-30 over 8. Now it's 8 pref, 60-40. But also I got a whole bunch of additional fees. That shift continues to happen with good sponsors. We see it too. There's nothing fundamentally wrong with that. They build reputation, but the pattern happens. And it's true, by the way, if you're wearing the sponsor hat, and the same is true as a fund manager. As we continue to do good returns to investors, the next fund we're going to launch is going to improve economics a little bit for us. We almost earned it because that's what it comes down to. The other thing that's driving this, exactly this, is the yield compression. So yield compression is what's driving lower interest rates, lower general returns, more competitive environment. Basically can't get investors to the same 20% IRR, what used to be 20 a couple of years ago, with the same level of risk, maybe now 16, 17. It's a harder sell. But that's what it is. So we know this. Investors don't necessarily know, and it's more education to get them to expect lower returns at the same level of risk, or higher level of risk at the higher level of returns.
Mm-hmm. Absolutely. I think that's a great place to wrap it up as we're coming up on time. But Mike, thank you so much for coming on the show and sharing your knowledge and experience with everybody. If they want to learn more about you, follow along, check you out, where are the best places to do that?
BigMikeFund.com. Let me say it again. BigMikeFund.com.
Yep.
I on purpose misspelled it, right? And I promise it's not a kinky site. It's really BigMikeFund.com. But if you mistype it, BigMikeFund.com, I guarantee you're not going to wind up in some exciting site. So it'll URL forward, hopefully, to our site. So
exactly. All right, guys, make sure everybody listening, make sure you go check it out, hit him up, and learn a little bit more from him. But thank you guys so much for listening to this episode of the podcast. If you're not already subscribed, it would mean the world to John and I if you would do so. And if you are, please send it to someone that would get a tremendous amount of value from this episode. Mike, once again, thank you so much for coming on. This is awesome.
Thank you, Chris. Thank you, John. My honor. I appreciate you guys.